Muted.
However, the recent injunction announced last week puts a hold on the new laws and leaves employers wondering, now what? During today's webinar, we will help you understand the now what and what you can do now and moving forward. Also, we will discuss accounting for employees versus independent contractors and when you should file a 1099. Lastly, we will discuss year-end tax planning that you can implement today. Today's speakers are Catherine Wells. Catherine is a member of Kiesa, Shahinian, and John Tomas Executive and Management Committees, the chair of the firm's Employment Law Group, and a member of its litigation group. As a commercial litigator with more than 25 years of experience, Catherine represents management in all types of employment-related matters. Deirdre Hartman, one of our partners here at Nizabachia, has more than 20 years of tax experience serving individuals, private and family-owned businesses. She also leads the healthcare practice group at the firm and specializes in accounting and tax services for multi-practice healthcare facilities and medical practices. Marcia Geltman, also with Nizabachia, our tax partner, specializes in estate and income tax planning as well as tax audit representation for individuals as well as private and family-owned businesses. Now with that, I will hand it over to Catherine to help us understand the latest developments with the new overtime rules.
Good afternoon, everyone. As all of you know, last week a Texas judge enjoined the final rule, which was to take effect as of December 1, 2016. And so our topic changed a little bit from what to do to now what can we do as opposed to what we're required to do. But in order to assess the final rule and its impact, we really need to have an understanding of the wage and hour laws that govern how we treat our employees. And first and foremost, there is the federal layer of the law, which is the Fair Labor Standards Act. And the Fair Labor Standards Act applies to all businesses engaged in interstate commerce and which have gross revenue over $500,000. For those employers covered by the Act, they are required to pay employees a federal minimum wage of $7.25 per hour, as well as overtime for hours in excess of 40 hours in a given work week. The only exception to the payment of overtime is if the employee is qualified or constitutes an exempt employee. And we will talk about that in a few minutes. In addition to the Federal Fair Labor Standards Act, New Jersey has two laws, the New Jersey Wage and Hour Law and the New Jersey Wage Payment Law. The Wage and Hour Law is very similar to the Federal Fair Labor Standards Act, and in fact, in order to finally make things a little bit more consistent, New Jersey a few years ago adopted or expressly stated that they will, that the federal regulations under the Fair Labor Standards Act will be applied in New Jersey. So at least for New Jersey employers, we have some consistency. Like the federal government and New Jersey, New York has its own minimum wage act, and the wage board routinely issues wage orders which explain the various New York laws with regard to wage and hour. New York, for anyone operating in New York is very, very different than New Jersey on many issues, so as well as the Federal Fair Labor Standards Act. So you need to tread very cautiously when you have New York employees or you're operating in New York.
Hey, Catherine, I have a question. Some of my clients want to know if there's more than, is there a limit? How many employees to be subject to the New Jersey, wage and hour laws? Is there a minimum number of employees? Who does it apply to?
So many statutes in the employment setting, such as the Family and Medical Leave Act or the New Jersey Family Leave Act, have minimal number of employees in order for the employer to be covered. That's not the case with any of these laws. As I mentioned, the Federal Fair Labor Standards Act, the determination of whether you're subject to that is whether you're engaged in interstate commerce and whether the employer has gross revenues over $500,000. New Jersey doesn't even have a limitation or minimum threshold like that. It says any employer or individual, proprietor, doing business, and for whom another provides services is subject to the Act.
Great, thanks for clarifying that.
So the big question here is, have we properly classified employees as exempt from overtime? And, at issue, particularly as it relates to the final rule, is whether or not someone qualifies for what's called the white-collar exemptions. And that is the executive exemption. Someone such as a CEO, a CFO, or you have individuals who qualify for the administrative exemption. And, while some might believe that the administrative exemption applies to, an administrative assistant or someone who performs administrative functions, that exemption really is focused on someone who is in a high level that really plays an integral role in the business. It could be an executive administrative assistant, someone who is the right-hand person, but really it's someone in that high level. And the final rule also comes into play with the professional exemption, and those that qualify for that exemption are typically your attorneys and accountants, who are your learned professionals. But also, the professional exemption also comes into play because there's another professional within that classification, and that is the creative professional. So that would be somebody such as a chef or an artist who really focus on creating something unique. And lastly, the Department of Labor's final rule impacted what is the highly compensated employee, who is also treated as exempt. Currently, a highly compensated employee had to make $100,000. Under the final rule, that salary was increased in order to maintain the exemption. So the final rule and also the Fair Labor Standards Act reaffirms that non-exempt employees, that is, employees who don't perform certain duties and meet certain salary thresholds, must be paid for overtime in excess of 40 hours in a given week, based upon a rate of 1 1/2 times their regular rate of pay. And so what this reiterates, and the Department of Labor's rule has resulted in significant discussion about, is, as we see, the clock. Making sure employees are carefully tracking their hours. And this is not just an issue that arises out of the final rule. Wage and hour litigation is on the rise, and one of the most critical tests is, whether or not you can avoid litigation. And in order to do that, it's critical that employers make sure that employees are clocking in and out, that employers are paying employees for all time worked, And that, in fact, they are paying them overtime for all time in excess of 40 hours in a work week.
Marcia, I know that you have handled some labor audits. What kind of paperwork, should employers be keeping to make sure that, they're in compliance with the wage and hour laws?
I handle audits with the IRS, with the state of New Jersey. I have to say that the wage and hour audit is the worst and the most difficult audit to get through. They are looking at timesheets. They're looking at benefits. They're looking at everything, and the penalties are significant. It's a really tough audit. Catherine, I had a question for you. If someone takes a vacation day, do you know how that impacts that 40 hours a week?
So an employer is only obligated to pay hourly employees for overtime for all hours worked. So if someone takes a sick day or a PTO day or a vacation day, that is not considered hours worked within the 40. So if I worked 48 hours, but 8 of those hours were a sick day, I really only worked 40 hours.
Thank you.
So under the current regulations, which will remain in effect after December 1, an employer will be considered exempt from the overtime rules if the employee works on a salary basis. Well, what does that mean? Working on a salary basis means I make the same amount of money every week unless I've exhausted and used all my vacation and accrued paid time benefits. So if, for example, I make $1,000 a week and I have to take an hour to take my child to the doctor, I still get paid $1,000 a week if I'm working on a salary basis. Under the current regulations, which have been in effect for decades, the exempt employee must make a minimum of $455 per week. And I can tell you that this $455 per week minimum salary threshold has been in effect for as long as I've been practicing law, which is in excess of 25 years. And that was precisely the reason why the Department of Labor was charged with evaluating the salary threshold that was subject to the final rule. And finally, and most importantly, the determination of whether an employee constitutes an exempt employee is not simply about salary. And it's not simply about job title. It's about what the individual's job duties are. They must be duties that are consistent with each of the exemptions. So the bottom line is the determination of whether somebody is exempt or not is a two-part analysis. The first part is the salary. Is the person making $455 a week, and do they get that salary regardless of the number of hours they work in a particular week? And the second part of the test is what are the person's job duties, and do they fall within the particular classifications of an exempt employee?
Catherine, that $455 per week, just to put it in an annual term, it's $23,660, which really isn't very much, which goes back to what you were saying. This number's been in existence for a long time and it's never really been updated.
So, and that has been the life of the Fair Labor Standards Act. The Fair Labor Standards Act was enacted in 1938, and for more than half a century, no one was really paying real attention to it. And it wasn't until 2001 when the Department of Labor was charged with updating the duties test, because the duties test was so confusing. There was a short test and a long test. And they did that and finally issued new rules in 2004. That was when the plaintiffs' lawyers remembered that this law is often forgotten, and it is the new litigation of this century. And so from 2004 till today, we are getting constant questions about this law. And finally, the Department of Labor was charged with updating the salary portion of the test. And although that now remains to be seen when and if that will be implemented. So, the Department of Labor was charged some time ago with updating the salary portion. And on May 18th, the Department of Labor published the final rules to update the regulations. And really, the final rule focuses exclusively on what is the salary for an exempt individual. And the rule was to go into effect as of December 1. As many of you know, last week a federal district court judge in Texas enjoined the rollout of the rule and concluded that the Department of Labor had exceeded its authority in increasing the salary for an individual to be deemed an exempt employee. That rule, so that leaves us in really a state of flux. But let's look at what the rule provides. And under the final rule, the Department of Labor issued the salary increased from $455 per week to $913 per week, which is essentially doubling the amount. And at a minimum, in order for an individual to qualify as exempt, he or she must earn on an annual basis $47,476 per year. The highly compensated employee who, in order to qualify exempt under the current regulations, has to earn $100,000. Under the final rule, the minimum salary for a highly compensated employee was increased to $134,000 and change. The new rule, unlike the current law, provides for salary adjustments every 3 years and also permits 10% of the salary to be derived from non-discretionary bonuses, which is significantly different than the current law. So to be exempt, currently I have to earn $455 per week, but no portion of that can be attributed to bonuses or commissions. Now, even though the Department of Labor, well, I shouldn't say now because it's not going into effect, but under the proposed rule, someone earning $913 per week would be deemed exempt, although up to $91 per week could be derived from either bonus or commission, so long as that was paid on a quarterly basis.
Catherine, just what's the likelihood that this is going to be reinstated?
So from a litigation standpoint, there is a preliminary injunction. It's entirely possible that there will be further court proceedings and a permanent injunction may or may not be issued. If that were to happen, I would suspect, based on recent other challenges to Department of Labor rules, that it would take some months. But then again, we have a new administration coming in, and who knows what, if anything, the Trump administration would do with this. And it's going to be in flux for some time.
Thank you.
So the question is, what are employers doing? Many of our clients are maintaining the status quo. They are going to continue to pay employees in the same fashion, although they are double checking and making sure that their record keeping is on, up to snuff. It's a good time to do that. But many employers have already promised to increase salaries in order for employees to be exempt. For instance, Walmart committed to increasing the salaries of its employees from $45,000, its assistant managers from $45,000 up to $48,500, so that those individuals would be maintain the exemption. The question now is Walmart going to, continue to, fulfill that promise? They have no legal obligation to, but
so it's interesting.
it remains to be seen.
An employer has no legal obligation to continue paying a bonus or an increase in wages after they've told the employee that they're going to do that.
So under the wage and hour law, an employer must give an employee advance prospective notice of the wages the employee will earn in advance of the time period that the employee is to provide services. So many employers have said, effective as of December 1, we're going to
Muted.
will apply to not-for-profits if that not-for-profit has gross revenues in excess of $500,000 and is engaged in interstate commerce. And to be quite frank with you, the notion of interstate commerce, it really shouldn't even come into play, because every business engages in interstate commerce, whether it's through the internet, using the phone, things like that. So for a not-for-profit, the key is, do you have gross revenues in excess of $500,000, and where are those gross revenues coming from? If they're coming from contributions, membership fees, dues, cash contributions, those types of donations do not qualify or go into the calculation of what constitutes gross revenue. On the other hand, if a not-for-profit is generating revenue from program fees or things of that nature, then that in fact will come into play with the, in determining the gross revenue.
Okay, thanks. Okay. Laura, do we have any questions from the queue?
Nope, we had one, but we also answered it at the same time. So we can move on.
Perfect.
And if anyone has any questions, you can type them in, or you can contact us afterwards as well.
Okay, everybody, so hopefully you've digested everything that Catherine has just spoke about, as well as your turkey. As we come back from our long Thanksgiving weekend. So today I'm going to talk about employee versus independent contractor. And this is a question I get a lot from my clients. They really don't know when they're, taking somebody on, to do a service, if they're going to, going to take them on as an employee or an independent contractor. So there are two agencies that, we rely on to determine whether somebody is an employee or an independent contractor, and those are the IRS. And speaking mostly for New Jersey clients right now, it's the New Jersey Department of Labor. So when hiring somebody to do a job for you, slide. Okay. Laura,
Yeah, we're having some technical difficulties here, but I did get a question.
Okay, go ahead.
Hang on. My trap stuff. What is the status of the computer programmer-related employee exemption? And then, is that considered program funds?
I'm not sure I understand the question as it relates to funds, but a computer professional will be exempt from overtime if that person is providing high-level computer functions, such as programming, analyst-type work, and the individual must make, I believe it's $27.63 per hour at a minimum in order to qualify as an exempt employee.
All right, thanks, Catherine. Okay, so when an employer picks up a worker to do a job, you know, the question is, are they an employee or an independent contractor? That really determines, and if the employer controls what and how is going to be done, then that person would be considered an employee. If the employer controls only what the final results will be, in that case, the employee would be an independent contractor. So when we talk about, you know, how the IRS determines this, there's 3 levels of control, you know, that the IRS looks at. Who has the behavioral control in the relationship? Who controls the financial, you know, the financial control in the relationship? And also, finally, what is the type of relationship? So you can look and see some of those things that are listed. You know, does the employer control, you know, when, how, and where the work is going to be done? Are they providing those services personally? When it comes to the finances, who is using, whose equipment is being used? Who is paying the expenses of the employer? Sometimes I get the question from my clients and say, well, you know, I'm only hiring somebody for 10 hours to do my filing, so that person is, you know, just part-time, so I'm going to put that person on the books as an outside contractor as opposed to an employee. You know, unless these 3 areas are looked at in the relationship, you really cannot just say just because the person is part-time that you're going to treat them as an outside contractor.
Deirdre, if I may, 2 points. One, the example you just gave of, you know, a part-time employee, classifying a part-time employee as an independent contractor has huge risks beyond the IRS or Department of Labor. Let's assume that employee who comes in to perform filing gets injured. If that person is classified as an independent contractor, that employee is not eligible for workers' compensation, and therefore the employer does not have the protection that workers' compensation insurance would otherwise provide if the individual was properly classified as an employee.
So does that mean that that employee could sue for amounts that would exceed what the workers' compensation benefits would apply?
Absolutely. So what could happen is if the individual was severely injured, workers' compensation would be if that person was classified as an employee, workers' compensation benefits would be that individual's exclusive remedies. On the other hand, if that person was classified as an independent contractor, they can go right after the business owner. And if the person was misclassified, you likely would not be protected by your general liability policy. So you're on the hook.
Got it. So, you know, just to go through an example, you know, so if you had Joe, the plumber, he works for Company A when they need him. He comes and he's been doing this for years. He brings his own tools. He's not controlled anyway as far as his job performance. Company A will tell him what they need done, so they control the final results, and the company would reimburse him for any materials needed for the job. But Joe bills the company for his materials and labor, at the end of the job, and he lists the payment terms on his invoice. He also works as a handyman and a carpenter for other companies as well. And in addition to that, he can he doesn't have to perform the services himself. He can send his worker to do the work. So in that case, the IRS would likely see Joe as an independent contractor. You can see that the behavioral control is in Joe's, in his wheelhouse. He controls the financial side, and he also is controlling the relationship. But if we talk about that worker that he sends, Joe has control over that worker, when he's going to go to that job, he's going to pay him. He controls the type of relationship. The worker is now considered an employee.
Deirdre, I just want to add, this has become a very big issue with the IRS for a number of reasons. And one area that they've really focused on is once somebody has developed that employer-employee relationship, any other work they do for that employer is considered to be wages. So in other words, if you have a teacher who's being paid salary but then is coaching in the afternoon after school, the coaching fees that they receive is considered to be additional compensation. So you would not issue the same person a W-2 form and a 1099 form.
I get that question a lot too, because I'll have clients that have an administrative person, and then on the weekends they may come in and do cleaning, possibly. So they want to issue a 1099 for the cleaning and then issue a W-2 for the administrative work. So you're saying that basically is not going to fly, right,
Once
Marsha?
the employer-employee relationship's been established, that it's wages, yeah.
Got it. Thanks.
And I'm sure you're going to get to this, but I also wanted to just to mention, speaking of audits, that the IRS again is coming down really hard on these. If you don't issue an independent contractor a 1099 form, the penalty is 28%.
We're going to get to that.
The amount that they pay. Well, it's worth reiterating. It's a huge penalty. Okay.
So, we're going to talk about, 1099s. The IRS, like Marcia said, has been taking this very, very seriously. In the past few years, they've taken it so seriously that they've added 2 new questions on all business returns. So the first question is, did you make any payments that would require the filing of Form 1099? So you need to answer yes or no. And then the second question is, okay, you did? Well, did you actually file them? So you do not want to check the first box and say, yes, I did, but no, I did not file. Obviously, that's a huge, huge red flag. So that's something that every business needs to be aware of, that this question now is on your tax return for filing. So talking about 1099s, who needs to issue 1099s? So when a business makes payments made in the course of your trade or business, so does that mean that I'm a contractor and I'm building a house for somebody and I go to Home Depot to buy my supplies? Do I need to actually issue a 1099 to Home Depot? The answer is no, not for supplies. But if you pay $600 or more for rent or services, prizes or awards or other types of payments, yes, you do have to issue a 1099 to the recipient of those payments. A lot of times people are confused that LLCs, I'm going to tell you that 1099s, you do not have to issue 1099s to corporations. Many times my clients will say, okay, that's a limited liability company, so that's a corporation. I do not have to issue a 1099 to that business. Is that true? The answer is no. An LLC is not a corporation, so it does not fall under that exemption. Also, at times clients are a little surprised that they actually have to issue a 1099 to their landlord for rent. So that's just something else that I see a lot of confusion. But if you pay rent to your landlord, you must issue a 1099.
Peter, one comment too. It says in the course of your trade or business, nonprofits are also required to issue 1099s.
Correct. Yes, they are. So this year, when is the due date for filing? So this is new. So if you just want to highlight, that first line there, the first bullet. In the past, the recipients were due their copies by January 31st, and then the IRS copies were to be filed by February 28th. The IRS has pushed up their copies to be filed with them instead of February 28th. They've bumped that date up to January 31st. So it's going to be a little rough for employers this year because, you know, if you wait until you do your bank recs or your bank statements, you know, you may get that in on the 10th of January. By that 31st of January, you will need to have all of those 1099s filed with both the recipients and the IRS. So a little bit of extra work, you know, to be done earlier in this year.
Okay, Deirdre, just hang on a second. We do have a question. Do you have to issue a 1099 to other 501(c)(3)s?
So are they performing services for you? Are they performing services, or what is the, you know?
Yes,
they're performing services.
Yeah, they are.
I am not sure of the answer to that question. I think I would have to look that one up. Marcia?
Yeah, I think they do, but
I'm
want to look
going
it
to say
up.
probably,
Let me
yeah.
look it up and we'll get an answer
I
for
think
you.
so also, but we will definitely get back to you.
Okay.
Yep.
Okay. I'll write you down. Okay. Thanks. Great.
Okay. And just one more thing, you know, what do you need in your files? When you prepare 1099s, you just want to make sure that you have from the worker a completed W-9 form. We want to make sure that if you're giving a business name on the W-9 form, the W-9 is basically the confirmation of the tax identification number and the name. So if you're giving a tax ID number, the name on the W-9 should be a business. If you are hiring somebody as a sole proprietor, the name would be their individual name with the Social Security number. If you do not get that matching correct, you will get a notice from the IRS that if you do not get the correct information, you may be, you know, that vendor may be subject to what they call backup withholding. And again, you want to make sure that you have a workers' compensation insurance certificate on file also.
Correct. In addition, Deirdre, in my practice as an employment lawyer, what I've been noticing is that in certain jurisdictions, issuing a 1099 to an individual Social Security number may trigger a Department of Labor audit to see whether or not you've properly classified your independent contractor as such. And depending upon what the DOL finds, it may result in a bigger wage and hour audit.
It's like a no-win situation, I think.
Exactly. Exactly.
The question I get asked very often, when someone is an LLC, a single-member LLC, reporting the income on their 1040 Schedule C, how do they complete the W-9 form? In that case, the W-9 is completed with the individual's name and Social Security number. And the reason is that the IRS wants to be able to match those up, and the only way they can do that is with the tax return, the name, and the Social Security number. So even though you have an LLC, you still want to use the name, a single-member LLC, you still want to use the name of the individual and the Social Security number.
Great. So if you're, you know, you do the right thing, you go ahead and you issue those 1099s on time. So what if you don't issue those 1099s on time? So if you file the 1099s late, but you're not that late, you know, you file them, you know, within 30 days of the original due date, the penalty is $30 per information return that you did not file. So that means $30 per 1099 you did not file. If you wait and you file those 1099s late and it's before August 1st, it's $60, you know, per information return not filed. And then if it's after August 31st, you know, Marcia has a lot of experience. She's seen this. You know, if it's late, you're an outside contractor. You know, it's $100 per information return file. But in real life experience, Marcia, what have you been seeing?
If you are hiring an independent contractor and you're not issuing a 1099, the IRS is assessing a 28% penalty on the amount that you pay them. And we've had penalties $150,000 and up, you know, under these circumstances. So you really have to make sure you're issuing 1099s where they're applicable.
So that's the bad. Now here's the ugly. This is the really ugly situation. This is when the IRS comes in and says, you know what, this person really was not an independent contractor. This worker was an employee. and as such, you should have withheld Social Security and Medicare tax, their portion. We're now going to make you match that, so now you're responsible and on the hook for the employers and the employees portion. And you did not withhold, federal withholding tax, so they will take an average of what should have been withheld, and that is what they are, having you pay in. And just to put this in perspective, normally employees will, this could be about a 30, this is in excess of that 28%. Because normally what will happen is the state of New Jersey will follow suit as to what the IRS does. So just the employee and the employer's share of the Medicare and Social Security tax, that's 15.3%. Then depending upon that employee, what type of federal withholding tax based on their number of exemptions and the state of New Jersey, we're talking a really big number here.
And Deirdre, the ugly can get uglier because there's not only the Department of Labor and IRS to worry about, but once an employee is determined to, once an independent contractor has been adjudged to be an employee, there's also the risk of a civil lawsuit under the wage and hour laws, because the misclassification of an individual as an independent contractor is a violation of those rules and laws.
This is getting depressing, but I'll add to this pension implications as well. If somebody's considered to be an employee, they should have been paying into a pension plan, or the employer should have been paying on their behalf. So it gets really complicated.
Right, and some of the other things that are on the line here too is we know now that a full-time equivalent employee is somebody that works 30 hours or more. Should you have been, paying for that person's health insurance, the health benefits, like Marcia said, a retirement plan. So there's a lot of things on the line here. So we just want to make sure, even though we want to give thanks for all of the information we have here today, so we know what the right thing is to do.
Hang on, Deirdre, we have another question.
Okay.
Do we get a copy of this presentation? Would help for training staff. Yes.
Not a problem.
Yeah. Okay, Ed, we'll get that to you. Okay.
Sure.
Go ahead.
And just to talk about, the state of New Jersey has a similar tests, an ABC test. Is the worker free from the direction or control of the employer? Does the worker provide a service outside the employer's usual business or place of business? And is the worker engaged in an independently established trade, occupation, or business? So what we can send to people on this webinar, we have basically the checklist for the auditors that come in, when they're looking at your records to determine this. Some of the questions they will ask you is, do you have helpers on the job or do you work alone? Basically, they're trying to determine who has the control. Are you required to provide all services to the company, or can you send a replacement? Did you have any other clients, or is this your only client? So these are the type of questions that a New Jersey Department of Labor auditor would come in and ask. Are you registered in the county to do business? So, that's what they're looking to make sure that your business is independent. Do you work at home? Do you use your own equipment? So all of these questions, when they're all answered, will make the determination as to if you've met these three tests for the state of New Jersey. Marcia, what have you seen, DOL audits?
Yeah, the DOL audits are looking for these kind of issues, and they're fairly aggressive as well. Everybody's looking. Whether we talk about the DOL, Department of Labor,
Department of Homeland Security. I just went through a Department of Homeland Security audit, and they weren't just looking for I-9s. They were asking to see 1099s and to see if you were avoiding the immigration regulations by characterizing individuals as independent contractors.
Yeah, great.
Everybody's looking out to get some more money. That's the bottom line. Yeah.
Okay, if you have any questions, thank you. Send them in. We'll get back to that one person very shortly.
So I thought we'd finish up on a more positive note. Year-end tax planning tips. A few tips for business owners. Now is the time, if you're considering buying any tangible property such as computers or furniture, now is the time to do it. Under the expensing allowance, you can expense rather than depreciate up to $500,000 worth of equipment. That's important. And you know what, if you don't have cash, I have one particular client, he just charges everything at the end of the year. That's fine. As long as you place it in service in 2016, you get to write it off in 2016, even if you don't pay for it in 2017. So consider purchasing assets now that you might want to use in your business. Just two caveats. First of all, it can be new or used equipment, so that doesn't matter. But two caveats. Rental property is not considered to be a business for the purposes of this expensing allowance. So if you own furnished rental property, don't go out and buy additional furniture right now. You're not going to get the benefit of it. For expensing allowances, you can still depreciate it, but that's going to be over a period of years. And the other is that the expense can't exceed the taxable income from that business. So if your business is running at a loss, this may not benefit you. Always, accountants, we've always learned from day one you want to accelerate expenses and you want to postpone income. And so how do you do that? You know what, any bills that you can pay now, go ahead and pay now. Postpone income. If you're not billing people, don't bill them till January 1st. If you can, you know, if there's any way to postpone the income, do that. We always say that because it's much better off to pay your tax later than it is to pay now. But with the new administration coming in and they're talking about lowering the tax rates, it's even more important now that you want to lower your income in 2016 if possible and pay it in 2017, and nobody really knows what the tax rates are going to be in 17, so why not? But again, accelerate expenses, postpone income. Some tips for individuals. 65 and older. Right now, the threshold for claiming medical expenses is 7.5% of your income for federal tax purposes. By the way, for New Jersey, it's only 2% of your income. But for federal purposes, you can only claim medical expenses that exceed 7.5% of your income. Beginning in 2017, that threshold goes up to 10%. So it's 10% right now for everybody except if you're 65 and older, and then starting in 2017, that threshold goes up to 10% for everybody. I've looked at some of the proposed tax plans for the under the new administration, and one of the proposals is to eliminate the deduction for medical expenses altogether. Whether that goes through or not, nobody knows, but certainly if you have any elective medical expenses that you can incur this year, go ahead and do it. At least you know you're going to get some tax benefit for it.
Marcia?
Yeah.
I know a lot of my clients will say, you know, I can deduct all of my medical expenses, but you know, can you explain the difference between the standard deduction and the itemized deduction? Sometimes they may have medical expenses that are subject to the limits. You know, those amounts, you know, that may not be the best thing for them to do.
Yeah, a good point. If you're 65 and older, and I don't have the number in front of me, the standard deduction is somewhere around $13,000, I think, and that might be for a couple. Generally, if you're 65 and older, there's a good possibility your mortgage is paid off, so you don't have your mortgage interest deduction. So instead of taking that standard deduction, you might be able to get your medical expenses over the threshold, or real estate taxes, or perhaps some type of miscellaneous itemized deductions. But very oftentimes, people 65 and older are better off taking that standard deduction as opposed to the medical expenses. But don't forget, on New Jersey, you're still going to get the medical expenses if they exceed 2% of your income. New Jersey doesn't have a standard deduction. Harvesting losses to offset gains. This is interesting. You know, oftentimes I'm asked to speak in front of groups, and it's always, people don't think about their taxes till March and April, which is, you know, really not a great time to think about taxes. November and December is the perfect time to think about it. What you want to do, you want to look at your investment portfolio. You want to see if you can match the gains with the losses. For instance, losses. New Jersey doesn't allow capital losses. I'm talking about losses on the sales of investment property like stocks or real estate or investments. New Jersey doesn't allow losses at all. So the only way to get the benefit of a loss for New Jersey purposes is to have some gains to offset it so that you don't end up with a net loss for New Jersey purposes. The IRS allows losses, capital losses, but limited to $3,000 a year. So if you have a significant loss on a piece of property or stock, let's say, you're only going to be able to use up $3,000 a year for however many years it's going to take to get the benefit of those losses. But if you can harvest some gains to offset those losses, now's the time to take a look and see if you can do that. Just one thing to remember, if you sell something, if you have a large gain this year and you look at your portfolio and you see that you have some stocks that aren't doing so well and you want to sell them off, sell them off. But if you want to buy them back, you have to wait 30 days. That's called the wash sale rules. So you're not going to get the benefit of that loss if you buy back that lost stock within 30 days. That rule doesn't apply to gains. So look at the inverse. If you have some losses and you're trying to match some gains with those losses and you have some stock that's appreciated, go ahead and sell that stock. You can buy it back the next day. But what you've done is you've taken that appreciation and you've offset it against some losses that you have. So you've received a tax benefit, and now when you go and sell that stock down the road, your cost basis is higher because you've rebought it back at a higher amount. So the bottom line is look at your portfolio. You really want to try and match your gains and losses if you can, and now's the time to do it. You can't do it on January 1st. It has to be before the end of the year.
Clients ask me, is that, my portfolio has gone up a lot, so I'm going to have to pay taxes. Can you explain the difference between realized and unrealized gains?
Right, so the market goes up and down. Right now the market's doing great, so a lot of people have realized gains, but they don't recognize it for tax purposes until they actually sell the stock. And the same thing with losses. If the market goes down and everybody says I've incurred all these losses, unfortunately you don't get the benefit of it until you sell the stock. So we ride the market, the gains and the losses, but until you actually sell something, it doesn't impact your taxes at all. Retirement plans, make sure that you take your required minimum distribution by the end of the year. If you're 70 and a half and you have IRAs, you're required to take your minimum distribution every year. Minimum distribution is, for somebody who's 70 and a half, it's somewhere ballpark around 4% of the value of the assets in the account. And that amount goes up a little bit every year. If you don't take your required minimum distribution, there are some pretty steep penalties that the IRS assesses. And in the past, the IRS really hasn't had the opportunity or the ability to check to see who's not taking those required minimum distributions. But their computer system is becoming more and more sophisticated, and they're now catching more people on this. So just make sure you take those distributions. By the way, if it's a 401k plan, you're not required to take your required minimum distributions until you actually retire. Net investment income tax. This came into being a few years ago, I guess with part of the Obamacare, and it said it's an extra 3.8% tax on your net investment income. And this applies to married individuals who have joint income of over $250,000 or single people that have income of over $200,000. The 3.8% tax is on the lesser of your net investment income or the amount that your income exceeds those two thresholds. But it's something to consider as you're approaching the end of the year and you're getting close to those thresholds and you have investment income. You might want to see if there's any way you can keep your income under that level to avoid that 3.8% tax. State and local real estate taxes, you can pay them in advance. So if you want to pay your first quarter 2017 real estate tax bill on December 31st, you can go ahead and do it and get a tax deduction. Deirdre, though, as you mentioned, some people may not be itemizing anyway. They're taking the standard deduction, so they might not benefit from this. But certainly if you do, you want to take your real estate taxes or state and local income tax deduction now. Pay your fourth quarter New Jersey estimate by the end of the year. It may not benefit people who are in the alternative minimum tax situation, but going back to the next administration coming in, they're talking about not only doing away with medical expense deduction, but real estate tax and state and local income tax deduction as well. So if that's the case and you can pay it in 2016 and get the benefit of it now rather than next year or not at all, now's the time to do it. Make sure you max out on your 401k plans. IRA contributions you can make by April 15th, but 401k contributions, they have to be made by December 31st. So very important. There's very few things that an individual wage earner, an employee, can do to minimize their tax, and one of them is to max out on their retirement plan contributions. So the 401k plan for those people is very important. And estate taxes. Everybody can gift up to $14,000 per person, per donor, per donee. So a married couple can give their 2 children 4 times $14,000 without it impacting their lifetime estate tax exclusion. Gift and estate tax exclusion right now for the IRS is about $5.4 million. So if you gift more than $14,000, it's not going to, you don't pay any gift tax. It simply eats up your lifetime exclusion. But so if you're thinking of gifting, now's the time to do it. Do it before the end of the year. Again, $14,000 is a freebie per donor, per donee. New Jersey estate tax, right now the exemption is $675,000. As of January 1st, it's going up to $2 million, which is a huge savings for New Jersey individuals. Up until now, a $2 million estate would generate about $100,000 in New Jersey estate tax. Beginning on January 1st, that same $2 million would generate no estate tax. And then starting in 2018, the New Jersey estate tax goes away altogether. So those are some things to consider before December 31st. And I think that's it.
Yeah, so thank you, Catherine and Deirdre and Marcia. If anyone has any questions, feel free to contact our presenters individually, or you can contact us. We did record this session as well, so when I send out the presentation, I can send out a link to the recording.